Hey, what is going on, guys? My name is Nick, and in today's video, I'll be sharing 4 wide-moat growth stocks that I will be buying on any dips in the near future. But first, let's just clarify what is meant by the term moat. So according to Investopedia, a wide economic moat is a type of sustainable competitive advantage possessed by a business that makes it difficult for rivals to wear down its market share. As a result, businesses with wide moats are usually the leaders in their industries and are insulated from their competitors, meaning that they're probably going to be around for the long term. Economies of scale, the network effect, brand strength, intellectual property, and regulation are all factors that can contribute to building a company's competitive moat. And the 4 growth stocks I'll be discussing today are no exception, meaning that they are excellent companies to buy for the long term on any dips that appear in the market. So if you do enjoy this type of video, make sure to drop a like so it does tell me that I should make more videos like this, and it does help support my channel, so I appreciate that. And if you haven't already, definitely consider subscribing down below for more weekly investing content just like this. But with that said, let's jump right into these wide moat growth stocks to buy on any dips. Alright, now the first wide moat company we have up on the list here today is none other than Visa, with ticker symbol V. Visa is the world's largest payment processing network, which facilitates transactions through their Visa credit, debit, and prepaid cards in over 200 countries. Visa makes money by taking a small cut off of every transaction that is processed through their network, which can range from 1% to 3% depending on the card that's used. And the beauty about Visa is that it's a very low-risk business model because they aren't offering that debt to the consumers. That's actually the bank that's providing the money. Visa only takes a cut off of every transaction that's processed through their network. Now, there are 5 main reasons why I see a huge moat with Visa, along with why they're going to grow a lot more in the future, in my own opinion. First of all, Visa is a hedge against inflation. Anytime the price of goods and services rise, Visa is still getting the same percentage of the product's value, which will increase their revenues as the value of that product rises. So essentially, as inflation goes up and the price of products goes up, so does Visa's revenue because they're taking a percentage cut off of that product's value. Second, a huge growth driver for Visa over the long-term future is going to be that global e-commerce expansion over time. Research analysts are predicting that another $1 trillion expansion of the e-commerce market is going to occur by 2025. And so companies like Amazon, Shopify, Facebook, Google, all of these companies are going to benefit through advertising and selling products. But then where does that money come from? It comes from the Visa cards. Any which way you look at it, Visa will benefit from this global e-commerce expansion because their cards are constantly being used online for purchases, and there are going to be way more people purchasing online and using cards rather than cash and debit cards, so that's a really good sign for Visa. Thirdly, Visa benefits from network effects. As I spoke about earlier in this video, the network effect is one key factor that can create a moat for a company. And basically what it means is that the value of its service increases as more people use it. For example, if we think of Facebook, the Facebook platform becomes a lot better as more people are on it because more of your friends can share stories, it becomes more entertaining, and overall it benefits the company and it benefits the consumer. Well, the same thing happens for Visa too, but in terms of credit cards and debit cards and prepaid cards. As there are more Visa cards in circulation, more merchants are going to be wanting to use that network because there are more people to access. And therefore it benefits both the merchant and the consumer because there's more options available for both parties. So in my opinion, Visa has a wide moat because of the huge adoption of their network, which makes it difficult for competition to jump into their industry and offer a better service. Now, the 4th point for Visa and their future growth is the expansion into new and developing markets. In North America, credit cards and debit cards are pretty much the primary payment method, but in developing countries, cash is still king, and that has a lot of money to transfer over to debit cards and credit cards. So over time, as more merchants in developing countries start accepting the Visa payment network, a lot more people are going to start accepting it, and the network effect is going to take off, and that'll just increase Visa's revenue. So the 5th and final point that I have for Visa is crypto. They're moving into the crypto space and the digital currency payment space. Recently, Visa started facilitating card transactions using your crypto wallets, and they've partnered with huge crypto brokerages like Coinbase, BlockFi, Crypto.com, and many more. As for now, this probably won't be a huge growth driver, but I can see over the long-term future, crypto is going to be a huge thing in the payments network, so I'm glad that Visa is already starting to adopt this. However, the only problem with Visa right now is the price. Their valuation is quite high in my opinion. Right now they have a trailing PE of 46, a forward PE of 31, and then a PEG ratio of nearly 2. So because Visa is on a minor dip right now, I might start nibbling a position away, but their valuation is still pretty expensive, so I'll be waiting for a little bit more of a dip before I build out a huge position in Visa. Because one day I can see Visa being a $1 trillion company, which would only be a double up of their market cap right now. Alright, now the second wide-moat stock that I'm going to be talking about is Costco, with ticker symbol COST. For those who aren't aware, Costco operates membership-based warehouses in 8 different countries, offering a limited selection of goods in large quantities, but at the best prices. Honestly, Costco is probably one of my favorite places to shop when it comes to brick and mortar retail because they have really cool items at really good prices, and I always end up spending a lot more than I probably should at Costco. Not only this, but in some locations such as my hometown in northern Alberta, Costco offers their own Costco Tire Center where they sell tires for really cheap. They also offer Costco liquor, so a lot of liquor in large quantities but very cheap. And then finally Costco Gas, which is the cheapest gas you can find. And despite the pandemic impacting retail businesses worldwide, Costco actually benefited from the whole thing, with their revenue still growing 9% over 2019 levels, despite their warehouses having limited capacity and reduced supply due to COVID. Then in fiscal year 2021, the revenue growth accelerated to 13.4%, with e-commerce sales driving the growth at a 42.6% increase over 2020, which is quite insane. Now there are a few reasons why I'm still very bullish on Costco over the future, as well as reinforcing why they have such a large moat. First of all, I can see Costco growing the amount of warehouses and the places that they operate substantially. At the end of August of 2020, so the end of their fiscal year in 2020, there were 795 Costco warehouses worldwide. And when we compare this to Walmart, which has over 10,500 locations worldwide, I think Costco has a lot of room to grow, even considering the fact that Costco warehouses are much larger than a Walmart on average. But still, there's tons of room to grow. Secondly, Costco's membership revenue is essentially subscription revenue. Now this is the best type of revenue for a company to have because it's recurring over time and it basically locks in the customers. Once they've signed up, it's very likely that they're going to continue being subscribed to that service. And I think this is the most unique aspect about Costco and why they have such a strong moat. Because people aren't just paying for the low prices, they're also paying for the experience of walking through a massive Costco warehouse that's super clean and has awesome things in it. It's also a somewhat guided tour, kind of like IKEA, which also reinforces their moat because they force people to walk past some of the most expensive items and highest margin items in their store, which is totally different from something like Walmart, where the customers can go anywhere they want. My mom has always told me that she hates shopping at Walmart and much prefers Costco, mainly because of the experience. She finds that Walmart is really gross and usually isn't that cleanly. There's also a lot of people in Walmart and it's usually way too overcrowded. So you definitely get a different experience when you're paying to shop somewhere rather than just going to a normal grocery store. And thirdly, I can see Costco expanding their e-commerce sales like crazy in the future. Costco's already been growing their e-commerce sales like crazy, as I mentioned before, which is about 42.6% in fiscal year 2021. And I actually see Costco having a very similar business model to Amazon, in which you have a membership that then offers you the best prices for online goods. Just like Amazon too, Costco offers same-day delivery through Instacart, but then prices are slightly marked up, so it can be better to use Costco's own delivery service, which can be planned for a later date. However, while Costco's products might be cheap, their valuation certainly isn't, and Costco stock is basically always traded at a premium. As of now, their trailing PE is 40, with a forward PE of 34, and a price to earnings growth ratio of 3.9, which is extremely high in my own opinion. But Costco has some awesome characteristics I can see in being a wide moat company, and maybe this is why investors are paying so much for this company. But let me know, is it worth paying for Costco at these prices? Let me know in the comments down below. Alright, coming in with wide moat stock number 3, and that would be Microsoft with ticker symbol MSFT. As I'm sure we all know, Microsoft is a huge tech company that provides business software such as the Windows and Office suites, cloud computing through their Azure platform, business social media with LinkedIn, as well as gaming with Xbox and many more avenues. In fact, Microsoft has become one of the most well-diversified tech companies of our age, but in a very good way. And that's because they're investing heavily in future technologies such as cloud computing, AI, gaming, etc. So what is it about Microsoft that gives them a wide moat? First of all, Microsoft has a 75% market share of the desktop operating system market, which gives them a very strong brand. Anyone that knows how to use a computer likely has used a Windows operating system before. And just the fact that everyone is so familiar with their products and services gives them a switching moat, meaning that it's difficult or a nuisance for consumers to switch from Microsoft products to another company's products like the Office suite, for example, or Windows over to Mac. Secondly, Microsoft is the world's second leading cloud computing provider, only behind Amazon, which had a 7-year head start on the entire industry. But as of now, Microsoft has a 20% market share and is still seeing incredible Azure growth quarter after quarter as new companies are needing this service for the digital transition. And again, their Azure product gives them a switching moat because it makes it very difficult for companies to switch over to Amazon, even if the software is available to switch over. Just being able to use the product, people are so used to the Azure product that they wouldn't want to switch. Thirdly, Microsoft offers an incredible cloud gaming service that's still in beta, but it will be a huge success in my own opinion, because people won't even need to buy a gaming console anymore. This allows people to game online with other people from their smartphones or their computers. Since Microsoft has a huge amount of cloud architecture, they're able to shine in this area unlike some other companies. They have the massive data centers to be able to facilitate a huge number of people and high quality games, all of course under a monthly subscription service, which Microsoft is very well known for. And finally, Microsoft is able to produce a very high return on their invested capital, or the ROIC, while keeping their weighted average cost of capital, or WACC, quite low. As of June 1st, 2021, Microsoft had an ROIC of 26.4% and a WACC of 6.8%, which ranks them in the 96th percentile among technology companies. Essentially, this just means that they're able to provide a lot of value to their investors as they invest in new technologies. It doesn't cost them that much, and they're able to produce a very good return from it. In fact, we can see here from their recent earnings report that nearly every single segment of theirs is seeing high double-digit revenue growth year over year, except for basically Surface and Xbox content. However, in my own opinion, Microsoft's valuation really isn't that cheap right now, where they have a trailing PE of 36, a forward PE of 29, and then a price to earnings growth ratio of 2.25. So whenever Microsoft dips, I'll be buying back into this company, as I see a huge and durable competitive advantage for many years to come for Microsoft. All right, now getting into the fourth and last wide-moat company of all, that would be Google, with ticker symbol GOOG. Now, out of all of the companies that I discussed here today, I personally think that Google has the strongest moat of all. So Google is the primary search advertising behemoth, which also owns YouTube and is responsible for 92% of the world's search engine traffic. Just take a look at this chart, guys. Ever since 2010, Google's market share of above 90% has been unwavering, proving that people just continue to use Google without even thinking about it. Clearly, whenever you see a company with this type of market share that remains unchanged for over a decade, this indicates a huge moat that's insulating the company from its competition. Now, when it comes to YouTube, they currently have over 2.2 billion users, which is forecasted to grow to above 2.85 billion users by the end of 2025, being about 27% growth in 4 years. Now, YouTube is an insanely valuable social media platform because video ads can actually generate a lot more revenue per user than, say, banner ads that you would find on Google or Facebook or Instagram can generate. And Google said in their latest earnings report that YouTube ad revenue grew 84% year over year to $7 billion, which is quite ridiculous considering how old YouTube is already. So that alone also just shows the resiliency of the YouTube platform, and that there aren't really any other major video platforms that you hear about unless you're going on Instagram, Facebook, or TikTok. Anyways, Google has a ton of growth drivers working in their favor over the next decade, so now let's get into a few. First of all, Google is very much involved in cloud computing, just like Microsoft and Amazon, but they come in third place with their platform by size. Although Google Cloud is still operating at a loss, its revenues are growing very quickly, and when they turn profitable, this will be a huge profit driver for the company over the long-term future. Secondly, Google is and always has and probably always will be at the forefront of artificial intelligence. AI is undoubtedly going to be a part of the greater future, and Google is making it possible to sift through the entire world's information essentially and provide relevant results through the use of its algorithms, both on Google search and YouTube search. And currently, Google is trying to better the voice search functionality through their AI, and this would be super helpful for those people who own the Nest products, the Google Home, or even just on their smartphone devices through Google. And finally, we can see that Google is continuously benefiting from the growth of e-commerce and then ad sales online. In Q2 of 2021, Google reported unbelievable numbers. Their revenue grew 62%, while their EPS grew 169% year over year, mainly as a result of ad rates jumping from the pandemic. Forgetting all other avenues of growth that Google is investing in, I continue to believe that ad revenue growth is going to be huge for Google over the future, and it will continue growing as the adoption of e-commerce and online ads becomes more prevalent. As I stated before, the e-commerce market is expected to expand by another $1 trillion by 2025, and you can bet your bottom dollar that Google will be benefiting from that expansion. Overall, I think Google is kind of like Microsoft in the way it's well diversified, but also in a very good way. They're investing in all of the world's future technologies such as AI, deep learning, cloud computing, online gaming, and many more, so that's really cool, and I think it's going to solidify their moat in the future. Anyways, I hope you enjoyed the video. That's going to wrap it up, and the 4 Wide-Moat growth stocks that I discussed today are Visa, Costco, Microsoft, and Google, all of which I plan on buying on any dips in the near future. But guys, do let me know down in the comments below what you think about the valuations of these companies right now. Like, are they worth buying or are they overvalued? I would love to hear what you think. And so if you haven't already, make sure to destroy that like button to help support my channel and for all the research that went into this video. And if you haven't already, definitely consider subscribing for more investing content just like this in the near future. And of course, I will see you guys in the next one.